Is big tech's AI spending a boom or a bubble? Four giants, Amazon, Meta, Microsoft, and Alphabet, are pouring over 300 billion into AI annually. Investors are worried, questioning if it's reckless or a huge opportunity. Let's analyze the financials driving this AI frenzy. Back in 2016, they spent just 30 billion. Now, it's over 3 billion, mostly on AI-optimized data centers and NVDA GPUs. But they're generating huge cash flow, and it isn't desperate borrowing. Are the returns worth it? Microsoft, Meta, and Alphabet show impressive returns on invested capital. Don't think it's blind money throwing. They're highly profitable with confidence. That's not a red flag. Is AI spending justified? Or a bubble in the making? Let's dive in. In the past, they were all spending money on different things: warehouses, logistics, office space, and traditional data centers. Now, almost all of that spending is focused on AI-optimized data centers. And those data centers are packed with one thing: NVIDIA GPUs. That's why NVIDIA has become such a central part of the AI conversation, and also why concentration risk is making investors uneasy. Even more important, management teams at all four companies have already hinted that spending could go even higher next year, possibly approaching 400 billion. So the big question becomes, can they actually afford this? Where the money is coming from? This is where the story changes. Despite spending hundreds of billions of dollars, these companies are still generating enormous amounts of cash. After all capital expenditures, the four hyperscalers combined still produced around 200 billion in free cash flow over the past year. Let that sink in. Even after spending $300 billion, they still had 200 billion left over. That means this spending isn't being funded by desperate borrowing or shareholder dilution. It's being funded by some of the most profitable business models on the planet. And it's also so important to understand what they're spending on. This isn't maintenance spending. They're not just replacing old equipment to keep revenue flat. They're building new capacity to meet exploding demand for AI computing, where demand is currently higher than supply. Why free cash flow matters. Now, you might notice that free cash flow had dipped slightly compared to prior years. That's true, but it's not a warning sign. This decline isn't caused by weaker businesses or falling demand. It's the result of a deliberate choice to reinvest more aggressively into AI infrastructure. In other words, they're choosing growth over hoarding cash. And even after that dip, free cash flow remains extremely strong by any historical standard. What about debt and balance sheets? Some investors worry because a few of these companies have started borrowing money again. But here's the important context. They don't need the debt. They're borrowing because interest rates are still relatively attractive, and because they finally have something meaningful to invest in. For years, these companies sat on massive cash piles, earning low returns in money markets and government bonds. Now that cash is being redirected into AI infrastructure, assets that are in high demand and likely to generate much higher long-term returns. Even after years of heavy spending, these companies still hold over 130 billion in cash collectively. That's not financial stress. That's financial strength. Returns on investment, the real test. At the end of the day, none of this matters if the returns aren't there. And this is where the data becomes especially compelling. Microsoft, Meta, and Alphabet have consistently generated returns on invested capital well above their cost of capital. That means every dollar they invest is creating value for shareholders. Amazon has been more volatile, but recent spending is increasingly focused on AWS, which generates operating margins above 30 far higher than Amazon's retail business. So not only is Amazon spending more, it's spending more in its most profitable segment. That's exactly what you want to see as an investor. Is this a bubble? No, based on the financials, this doesn't look like reckless behavior. Opportunities like this don't come around often for companies of this scale. For long-term investors, that's not a red flag. It's a sign of confidence. This is not a financial advice. Happy investing.